So the change in value, and the change there happens because you just take the m minus t and carry it over to the other side, right? So that's how the delta arises. So the change in value for a security is a function of the two permanent costs multiplied by unexpected developments plus the public signal, which is the yt, right? Unfortunately, well, let me ask you, what do you think cannot be estimated from here? Which one of those little letters is still something that we can't figure out? The m itself, right? M is value. How do you estimate value from the data? You have to look at price, right? But price is not value, so we have to introduce prices into this. But when we introduce prices, we have to take care of the fact that in addition to those permanent costs, there are also transitory costs. Transitory costs don't affect value, but they affect prices. And since prices is what we can observe, we have to deal with transitory costs now. And we're going to denote those transitory costs as psi bar and lambda bar, and they're going to enter our final equation, which is this. Now, this equation here is actually used pretty widely by algorithmic trading computers, by hedge funds who specialize in frequent trading, high-frequency trading. So this is the stuff, this is the equation that is used relatively widely on the street. No one, of course, sits there and computes this with a calculator. There are high-speed computers who do this every second per stock. But technically, yes, this is useful stuff. Now, this stuff has flaws. And I asked you to try to catch something during my description of this model. So, what do you think is the flaw here? There are actually several, but let's catch the main one. It's not mathematics. Something else.
Because all of us into the past to the future.
Mm-hmm. Yeah.
And how guarantee it is.
Right, that's true. Yes, that's one thing. What else? By the way, you won't see this in your undergraduate program, so if you didn't like it, it's okay. I also said that traders are rational, right? And they have certain expectations, and those expectations are rational. And the fact that those expectations are rational allow us to model what these traders are going to do, right? Because, excuse me, if traders are irrational, you can't model irrationality, right? Because it's pretty irrational, crazy. You can't use math to model something that doesn't know or want to listen to math, right? And this is the big problem with all or almost all theories that we have in economics and finance. We have to assume things. And one of those assumptions is that people are rational. The other assumption that we often make is that markets are efficient. In other words, even if some people are irrational, markets will correct for those random people's irrationality because as a conglomerate of traders or investors, markets are rational. And even if the market is sometimes irrational, then there will be traders who will come in and correct for that. And those traders are called arbitrageurs, right? We assume when we model, when we create these theoretical models, we assume unrestricted arbitrage. Now, is it okay to assume that arbitrageurs can actually come in and fix everything? No, because sometimes arbitrageurs would ride the bubble instead of fixing it, right? Just like we talked about when it came to this financial crisis. Arbitrageurs figured that one of them is not going to be enough to correct for the problem, so they just started riding it, actually trading with the bubble instead of against it. So arbitrage sometimes doesn't work. Now, these are pretty big statements here on this slide, so we don't have time to talk about all of them. Let's just talk about people are rational thing. Once again, almost all theoretical models, especially the ones that were created several years ago, assume that people are rational, right? You have to. Because you have to somehow mathematically show that if you offer a person $3 versus $2, they will pick 3, right? If somehow they won't, then how are you mathematically writing this thing down? How do you predict what they will do if they don't even know or don't care about the difference between $3 and $2, right? Now, let's ask ourselves, are people rational? Let's actually figure out if you guys are rational. This is the interactive part of today's talk. So, if you can get a piece of paper each, or maybe if you have, or maybe you can just sort of, we're not going to be computing anything, I just sort of wanted you to write your answers down, but if you don't have a piece of paper, that's okay. Let's talk about frame dependence. So let's see, let's say I give you two choices. Choice A, a sure gain of $2,400. No matter what happens, you get $2,400. Choice B, a 25% chance to gain $10,000 and a 75% chance to gain nothing. What do you choose, A or B? Who chooses A? And now, we're not playing, do you know how to compute expected values? We're playing, what would you do in real life if someone asks you this question with real money? I don't have $2,400, I'm poor. So, what would you do, A or B? Who would pick A? Who would pick B? Now, what is the expected value of A? And what is the expected value of B? 2,500. So definitely B is better as far as expectations are concerned, or as far as math is concerned. But most people would pick A. When given this particular frame of reasoning, most people will pick the conservative solution, or conservative alternative when it comes to gaining money or making money. Here's another one. Choose C or D. C here is a sure loss of $7,500. No matter what happens, you give me $7,500. Let's do that. D, a 75% chance to lose $10,000, 25% chance to lose nothing. What would you pick? Who would pick C? Who would pick D? Almost everybody would pick D. Yes, that's what people would do, because when it comes to losing money, people would rather gamble. Now, from a mathematical standpoint, from a standpoint that a theoretical model would look at this, are these choices different? No, because their expected values are the same. Let me make this a little bit more, so before I make this a little bit more interesting to me, let me tell you, you guys gave exactly the answers that most people would give. Most people would not care that an expected value of one alternative is higher than the expected value of the other, because the other is a sure thing. That when it comes to gains. When it comes to losses, the whole thing reverses. So most people would choose A and D when given them separately. Now, let me make this more interesting and say, what if you had to pick two at a time? A and D, or A and C, or B and C, or B and D. Would you change your mind? Most of you picked A and D. Would you still pick A and D? Who would still pick A and D? If you have to pick two, both will happen to you. This is not a test, so you can. Who would stick to A and D? Who would switch? What would you switch to? A and C, B and C, B and D, what would you switch to? B and D. Ram? What's the best one?
A and C expectation.
Pardon?
A and C.
A and C.
Expectation.
Oh, I'm sorry. Oh, this is my mistake. Sorry, I forgot to tell you. You can only pick either A and D or B and C. We don't have two choices. Sorry about that. I totally forgot. Let's make this correct. So here we don't have this, because then it becomes kind of obvious, right? And we don't have that. So we only have these two. They wouldn't be under Shkilko if you didn't screw up one thing. So, would you stick with your A and D that you chose first when you were picking them separately, or would you switch to B and C? Right. You should switch to B and C. Why is that? Because that's where it's on the board. What is the expected gain from A and D? In A, you have a sure gain of 2,400. If you pick it with D, there's a 75% chance to lose 10,000. So if you combine them, there is a 75% chance to lose 7,600, right? So